Private equity groups, real estate companies, and large banks are gobbling up bank assets held by the Federal Deposit Insurance Corporation, sometimes at very favorable terms, maybe too favorable. In an analysis for Westlaw Business Currents, a unit of Thomson Reuters, ES Group Managing Director James Brennan raises questions about the competency of the FDIC to value and broker these deals. He joins me now from our studio in Washington. Tell me about the terms that you find puzzling, or some people are calling them, they're pretty sweet in some cases, right? With
the market for bank sales, what we're seeing is there's still a healthy appetite for these bank sales, 12 to 20 bids per bank sale. However, what we saw trending was the loss sharing provisions for the portfolios of loans. We saw them trending downward, meaning the FDIC was responsible for less and less indemnification per loan portfolio. And the last bank sale we saw was TD Bank in Florida bought 3 regional banks in Florida and had a 50-50 loan sharing. And that's way down from 95 and 80% indemnification about a year ago. But one sale that was puzzling was in Illinois, Broadway Bank. They went back up to an 80% loss sharing coverage ratio, which made us scratch our heads. And so that's the puzzling, is the fact that the FDIC is willing to indemnify these new acquirers of the portfolios 80%. So that's a pretty sweet deal.
Is it the inconsistency that you think is an issue? I mean, maybe that's just what the FDIC needs to do in some of these cases to get the buyers to step in.
Right. It definitely is going to be a case-by-case scenario. But what was interesting about this last transaction with the 80% was the acquirer was MB Financial, which bought Chorus Bank and about 4 other banks over the last 18 months from the FDIC. And there was also another provision in there, basically that was a warrant or stock option provision that allowed the FDIC to take an equity interest in MB Financial. And that's a very interesting concept from a policy perspective. Do we want a quasi-regulator or a flat across the board regulator taking equity interests in regional banks?
Is there a better way that you think this could be done?
Well, the way that they were on track seemed to make a lot of sense. Some speculators are saying these new warrant and stock option provisions are allowing the banks to maintain their capital ratios without using upfront cash. And so there's no better way from my armchair quarterback position, but basically it's just interesting policy, and it's interesting note to see what new manifestations and materializations we're seeing in these deal terms.
All right, deal terms on the FDIC, they are always keeping it interesting. James Brennan, Managing Director at ES Group, thank you very much. To read the analysis on this topic from Westlaw Business Currents, click on the link to the right of the screen. I'm Jen Rogers. This is Reuters.